Hey folks, this is your host, Paul Winkler. Thank you for listening to the show today. Before we get into the content, I want to tell you about a new workshop I'm hosting called Politics and Portfolios: How to Invest During Election Season. You can register for it at paulwinkler.com/politics. A lot of people are worried about the market this year, and I want to help you know what to do. We're going to look at historical data and academic research to explain how markets behave in election years, and we'll use easy-to-read charts and graphs. I'll be live on Friday, February 23rd at 12 o'clock. But if you can't make it live, register anyway, and we'll send you a replay link, so go check it out at paulwinkler.com/politics. Now, here's your show.
Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back. Ira Work, Evan Barnard, Paul Winkler here, talking money and investing. This is the Investor Coaching Show. PaulWinkler.com is the website. Boy, oh boy, I have to watch myself. Okay. Operating too many things at once over here. I'm like going multitasking. I'm looking at like screens over there, and because we got video going when we do this stuff too. Got to keep my eye on the ball, or on the T-rod, as it were, which is how I control cameras too. And if you've never seen us do the show, you're not missing anything.
Well, they can come watch me.
It's a full production over there.
It is a full production over here. Leviticus, come on over, join us. This is fun. We'll have a big time.
Yes, please.
Well, who's going to run the board over here at the B station?
Well, just turn on your video camera.
Yeah, it's just been Batman.
No.
Okay,
You already
so
know my answer.
So I do something every morning, so none of you have to. I do. I take a hit for the team every single morning, just about every single morning.
Hashtag.
Yeah.
Well,
and there was an article.
Networks,
What's that?
watching all the news networks and money market.
Yeah, pretty much. Yeah, you got it.
I knew it.
Nailed it.
Math
Yeah, you
guy
got
over
it.
there.
Yeah, so one of the things I do, it's funny because I was watching, I changed channels the other day. It was, my son and I were actually watching, and I was listening, and I was watching CNBC, and they're talking individual stocks. So they get into individual stocks, and I'm like, I was like, oh gosh, I hate talking about individual stocks. That nothing bores me more than hearing about what some company is doing or what they're not doing. But, people ask me about it all the time. So I guess I'm glad I watch, because people will say, hey, Paul, what do you think about Discover Card? And, all of that. And I was able to give a cogent answer as to what I thought about that whole deal, So, it's not all bad. But they're watching it, and I was a little bit bored, so I decided that I was going to switch channels. And I made the mistake of switching over to Fox Business. And guys, guess what Fox Business was all about? Because it's a business channel,
Stock
right?
picking.
No, it's politics.
Oh, okay.
It was all politics. And then I was like going, oh, gee.
Was that this morning?
No, it was today. It was
Thursday,
Friday.
I think.
It was Friday.
Friday.
Last Friday.
Right, because today all they're carrying is what's going on in South Carolina with their primary.
Right, and then what we did is I switched back to CNBC, and then it was politics again. And I was thinking, I was like, wait a minute. And of course, we had the workshop, Politics in Your Portfolio, that afternoon. And, so I watched it. I said, well, I guess some people are really interested in this stuff. But, the reality of it is we had the workshop and talking about politics and how it affects the portfolios. And it was, the short answer is it really, doesn't have any impact. The companies will be impacted by politics, no question. But how does it affect stock market returns? It's really pretty random, just like, and, if you look at Democrat versus Republican, you look at during recessions versus not during a recession, during an expansion, 2/3 of the time stock market goes up, 1/3 of the time it went down. No matter what statistic I gave, I would go and I would look at it in terms of percentages, and it was that. What happens when you're moving into an election year? What happens when you move out of an election year? It was 2/3 up, 1/3 down. It was just all the same the whole way. But anyway, CNBC was talked about in this one article in particular. And it says, if you wanted to design a financial channel that would cause investors to underperform the stock market, you'd create CNBC. What a great opening line. NBC's financial counterpart that runs on cable news and ostensibly tries to make viewers better investors. And they do, have subscriptions that you can sign up for to become a better investor. And they interview people. Oh, yes, I know way more than I ever did. And I just go, good grief. There's a difference between learning things that are helpful and learning things that aren't helpful.
Right.
Right?
Right.
Uh-huh.
And so often when you're watching these programs, you're not necessarily learning things that are going to help you. As he says in this article, Andrew Feinberg, and yet you'd ensure that viewers will stay engaged by keeping, he says, and basically what happens is you've got these people that are sober and rational. Well, there's Kramer. We'll get to him later, he says. But, they talk about you got to sell everything. You got to burrow and get underground and all of this. And yet you'd ensure that viewers stay engaged by keeping them on edge, he says, worried and confused about what might happen next.
Yep.
That's what I hate when I hear, I don't care if it's a financial channel or whether it's a news channel. Yeah. The Dow Industrial Average went up and blah, 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 blah. And financial companies will sponsor the report on the Dow.
Well, that's like a friend of ours who was on with Neil Cavuto when he was talking about how markets work and you have to own stocks long term. And he says, it's not rocket science. And Neil Cavuto says, quiet, it's my job to make them think it is.
That's funny. That's funny. A moment of truth that comes out. But yeah. I mean, that's really what it is. And it says, anxiety, you discover, is your friend. Viewer hypervigilance, your bread and butter. I mean, the idea is what they're trying to sell is the idea is that when you're anxious, you're going to be more aware. You're going to be more hypervigilant. You're going to be protecting your stuff. You're going to be watching things. I don't want to miss out on things. I don't want to miss when I should be getting out, before something. So I need to have that information to protect myself, which instinctively sounds so good.
Yeah.
I mean, it just doesn't it make sense that you ought to be kind of looking both ways before you cross the road?
Right.
Well, that's what I find to be one of the most frustrating things about watching those shows. Because, being in this business now 40 years, I watch it with a different eye than most people watch it. And they bring on two people that have opposite opinions. Mm-hmm. And I'm looking at this and saying, how do people watch these shows and actually make a decision about what to do with the portfolio? Because you have one stock guy who says, or one analyst who says, we're buying Procter & Gamble right now. And you have the other analyst that says, we don't really think Procter & Gamble is a good buy right now.
Right.
So how do you make a decision on what to do with Procter & Gamble based upon what you're hearing on CNBC or Fox Business News?
Confirmation bias. If you think it's going up, you listen to the person that said, hey, I think it's going up.
Yeah, whichever one resonates with you, that's exactly right.
Or you look around your house and you see all the Procter & Gamble products you buy and say, I might as well be getting some of these profits for myself.
So it says, in other words, you'd ensure that viewers stay engaged by keeping them on edge, worried and confused about what might happen next. And so they says, in other words, CNBC makes viewers nervous in a very specific way, nervous that they're about to lose money in a market downturn. And then you got some expert comes on and tells you, are you in the right sector? Mm-hmm. So you got, different sectors. You might have the healthcare sector. You might have the technology sector. You might have energy sector. You might have consumer durable sector. You have different areas. Are you in the right, biotech? Are you in the right sector based on what's going on right now? Problem is, hypervigilance is probably the worst quality that most investors can have. Sit on your back end. Not exactly the word that Charlie Munger used, but that's what he said. That's what he advised investors. And he says, all the evidence shows that individual investors do worse the more they trade. And yet that's exactly what they're encouraging you to do. You know, you look at turnover rate inside of funds. You know, I do this with people. I look at the buying and selling, and I look at your portfolio 5 years ago and look at how different the holdings are today versus what they were 5 years ago. I dare you to do it. You're usually going to find that it's not necessarily the same stuff that you used to own that you own now. And the reason being is because they'll be doing tactical asset allocation. Studies show that trying to move deftly from sector to sector is a mug's game. Means that CNBC is in the strange business of telling viewers that they can do things, time the market, pick winning sectors that actually can't be done.
Yep. Yeah.
I'm going to tell you that you can jump over the moon, you know, and you know, I can't do it. No, you can't. You know, just listen.
Yeah.
You know, it's sad because it gives them a false hope that they can do something. And especially when you have a person that's behind in their savings. Mm-hmm. Right?
Well, and the firms themselves will give you many, many different ways to gamble and speculate with your money. For instance, there's a big investment firm out there who has what they call thematic funds. So if you think that there's a particular trend going on or there's a particular idea, like I believe electric vehicles is the way to go.
Yeah.
They have a fund that is just supposedly electric vehicles. They have 40 of these different thematic funds.
Yeah, well, you just said something already that gets me. You know, you said, based on what you think is going to happen. I hear people say all the time, if you think inflation is going to do this, then you ought to do this.
Right.
What does it matter what I think?
Right.
It doesn't matter what I think is going to happen. I'm one opinion out of billions of people around the world.
So they have one for junk food. They have a junk food fund. Okay? I mean, come on, junk food.
Junk food fund.
They have a pet passion fund that invests in pet supplies.
No, that doesn't sound good at all.
Get your mind out of it.
Really? I mean, it's just...
Yeah,
So what are they doing? Investing in, you know, dog food stock or, you know...
You want me to look it up?
No. I don't want to know anything
firms
about
that
it.
sell pet trusts or something.
Yeah, so, and here's a guy that wrote the article, basically pointing out, and here's a guy that's disciplined writing this article. And, you know, there's a guy writing a book about people that make investing mistakes and the mistakes that they tend to make, as we talk about here on the show all the time, stock picking, market timing, using track record, historic performance to choose investments. And he says, literally, he's watching the channel in October, and he almost makes a $5,000 blunder on his own because he's listening to what somebody's saying and going, whoa, wait a minute. Maybe I do need to sell. It was Netflix.
Oh, uh-huh.
And he says, I think I probably need to. He's talking about Netflix's earnings. And he says, the man said confidently. And if you don't sound confident, he says, you don't get on CNBC.
Yeah.
And that's it. They sound really confident what they're saying.
Right.
They can really pull you in. That he said that the earnings would probably send the stock diving another 10%. Now, the operative word there is probably, right? Yeah. He says, as it happened further on down the article, Netflix surprised the street and CNBC and me with terrific earnings and excellent guidance. The stock rose 16.1% the next day. It's up 56.8% in 4 months since the pre-earnings close. I mean, it was supposed to go down 10.
That's a pretty good jump.
That's a pretty big difference. Part of CNBC's problem is that it actually does try mightily to help investors. And I believe this too. I believe this in, when you look at the typical financial advisor, mutual fund company. And that's the thing that gets me because, we always have to be so careful about what we say.
Yes.
We are so, when I talk about returns, you will hear me say expected returns. When I talk about risk, I talk about measuring risk. When I talk about, what might happen,
Right.
we are like really, really, we're very, very careful. And I just simply don't find that that's the case.
No.
In other industries, particularly, I hear the word always and never,
Will.
so often.
Should.
Well, no, I mean definitive words.
Yeah.
Like it always does this. It always will. I hear that in ads, and then I will hear, say this is, and the reality of it is they don't have to disclose conflicts,
Right.
of interest. And they might, if they do it,
Well, and
it's
if
in
they're
very, very fine print.
And if they're
in
a
the investment
journalist or
industry.
a writer, they don't have to disclose anything. They're exempt.
Right.
They can say anything they want.
It's opinion. Yeah. Freedom of speech, baby. That's it.
Yep.
So he says they try mightily to help investors. It seems to mean well, even as it sabotages investor performance. Its questioners are smart and well prepared. And I think that's the thing is you watch these TV programs and they have got the data. I used to kiddingly say that Jim Cramer knew the CEO's underwear size. I mean, he just knew everything. CNBC's broadcast day starts calmly. There's economic and political news. And, quite frankly, that's why I watch it. I watch it for the macroeconomic. That's why I said to my son, who's, going through microeconomics right now, I made the comment to him. I said, they're not talking micro. They're not talking macro. They're talking about micro. What's happening to this company. I don't mind microeconomics when you might be dealing with a local economy or something like that. But when you get into specific companies that you love, that's boring. That's macro, I think, is fascinating. What's going on around the world and what's happening with this country versus that. I was teaching the workshop Friday. I said, one of the things that we've done to actually combat inflation significantly is, and I showed the data. I was walking through the data and how much business has gone from China to India. How substitution effect. I talked a little bit about that, how that has actually been occurring with the public and how to reduce expenses and help with inflation that way, something that you wouldn't even think about. You always hear about inflation, but you don't think about substitution effect and things that companies are doing to actually reduce expenses and to control expenses. It says, then watch out, the parade of CEOs uber bullish on their companies no matter what travesties have befallen them begins.
Right.
And that's it. That's the whole day, right? It's like these, you need to stay in our here. This is why. And why would the CEO of a company be uber bullish about their own company? They want to keep their job.
Right. Well, they're inspiring their employees at the same time they're trying to reassure investors.
Totally.
Yeah.
Totally. So, watch it. This is so right on. It says that, these people are talking, they'll tell you that they're holding on to above average amounts of cash and, telling you that, this is how much cash we're holding. And it's all market timing. When you start to hear people talking about we're holding a lot more cash than normal, or, we're backing off on stocks, then they're basically, if you really think stocks are going to go down, sell them all. Why would you just back off on them? If you really think that stocks are going up, put everything in them.
Right. Mortgage the house.
If you really think energy stocks are going to do better than anything else, load up on energy. Don't even invest in technology.
Don't diversify. Just buy one stock. Buy the one stock you think is going to go up.
Which one?
Whatever one you think.
Just put it all on 00 or whatever.
No, exactly. Precisely. So, the frustration. Is that. Tell you what, let's take a quick break. We'll be back right after this. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out.
So we have 10 offices in the Middle Tennessee area, and everything we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degreed planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon.
All right, we're back here on the Investor Coaching Show. Paul Winkler, Evan Barnard, and Ira Work. Talking money and investing. PaulWinkler.com is the website. Evan, go for it.
Oh, I think
you were going to say something that was related last, but go ahead, whichever.
So how many millionaires do you think there are in the U.S., Paul?
How many millionaires?
How many millionaires? I mean, that's a lot of money, $1 million, right?
Oh, gosh.
3 million.
Yeah, I was just I'm trying to think of the number of people in the U.S. I'm terrible with this. I don't even clue how many people. It's like 1% of people, right?
I'm sorry, Leviticus?
No, Nick says
350 million.
Wasn't
350 million people. How many think are millionaires?
350 million.
People in the U.S.?
350, so about 4 million.
Over 22 million.
Really?
Wow.
735 billionaires in the U.S.
Really?
Was I on that list?
Yeah. Actually, you were at the top of the list.
Thank you.
Yeah.
Really?
Now-
I had no clue how many.
Now, this study says that they define a millionaire as somebody with a net worth of $1 million or more.
Oh, okay. So, yeah, not invested. Okay, gotcha.
Okay.
All right.
And net worth being you take everything that you own,
Assets minus liabilities.
take off everything you owe,
Yeah.
and whatever's left over is your net worth.
Okay. All right.
Being a multimillionaire means $2 million or more. And being a billionaire means that you have a net worth of $1 billion or more.
That would make sense.
Right. Okay.
Okay.
So they talk about like what does it take to become a millionaire in 8 simple steps. And that, the article says that a lot, it's actually within most people's reach.
It really is, yeah.
If they follow simple steps. So number one, and what's really interesting is that we all know these rules.
Right.
The problem is the difference between knowledge and doing is often a very large gap.
Yep.
Right.
So
behavior is a challenge.
Step number one, start early.
Mm-hmm.
Saving money for the future is a habit. And the sooner you can make that habit a part of your lifestyle, the better off you'll be.
Mm-hmm.
But you need to start today. Number two, what do we tell people? What do you need to do to save?
Pay yourself first.
Or
Systematic.
spend less than what you earn.
There you go.
Okay.
Oh, that was too easy. I was overthinking that.
Yeah, you see, there you go. I mean, this is easy stuff. To be honest.
I was like, this is a trick question. This is a trick question. He's trying to get me.
Always live beneath your means. Put it another way, saving should be part of your budget.
Mm-hmm.
And you always talk about that,
Right.
how even when you couldn't afford to put money away, you put money away.
Right.
Don't fall into the trap of paying all your bills and then saving whatever's left over. Pay yourself first, because chances are if you pay all your bills first, nothing's going to be left over.
Well, it's like I always like to say that one thing from the richest man in Babylon. Everybody has different incomes.
Mm-hmm.
Why do so many people end up with the same amount left over, which is zero, even though they have different incomes?
Right.
Technically, somebody should have something left over.
Right.
Yeah.
And that's one of the reasons why I encourage people to invest in their 401k, because if that money is coming out before you get your check, you don't think you have it to spend.
Right. Right.
Number 3, when you get a raise, increase your savings first. Then think about what's left over to use for other things.
Mm-hmm.
Always max out your retirement plan. Ideally, you should.
I like to let's hit that one before, because I think when people get a raise, if you get a 3% raise 5 years, you get a 3% raise every year, you're up to 15% of your income.
Mm-hmm.
I mean, that's, if you look at that, the vast majority of people would be just fine if they did that. If you look at the level of savings, typically 10 to 20%. If you're younger, you can get away maybe with 10% of your income saving. When you get a little bit older, you probably want to be putting away 20, because especially if you're behind at all.
Right.
But yeah, you can get to that point without a whole lot of work if you just save the pay increases.
Yeah, and I know that when I go into companies, because I'm very big on simple IRA plans, because there's no cost for the employer to have the plan itself. The match is a maximum of 3% for whoever puts money into the plan. And when I'm talking to the employees, I tell them, look, the goal is to save 10% of what you earn. That's the goal you should be shooting for. But if you have to just start at 3%, start at 3% and then increase it every year. And what you'll find is that if you're putting away that 3%, your paycheck will not actually be reduced by 3% simply because the taxes are based upon what's after that contribution. Okay? So if you're getting a raise, as you said, a 3% raise, you're only putting away 3% of that 3% raise, which is a really, really small amount. It won't even affect you. So consider maxing out your retirement plans first. This number 5, I find a little challenging for most people, and that's consider a side hustle. A little job on the side of what your regular job is. Maybe start a little small business or something. But
that's what this was for me at first. I used to sell health insurance, and while I was collecting financial planning degrees, I wanted to set up a little side hustle. And really, the whole investment, financial planning thing was kind of a side hustle in a way. But I knew I had to make the ends meet before that another way. So I did a lot of health insurance and group benefits and those types of things. They were somewhat related.
I thought you sold insurance so you could support your drum habit.
Well, that too.
Now, this number 6.
I've got a comment on that one. I was on a webinar a couple of weeks ago, and they were talking about side hustles, actually, in the gig economy and so forth. And depending on how you slice it, okay, because somebody just selling something on Etsy could be considered a side hustle, or someone selling something on Pinterest, not necessarily a job.
Right.
But it really blew me away. 92% of people have a side hustle right now.
Really?
92%. Now, that's not all second jobs necessarily, but they're doing something either to make ends meet or, as you're saying, to kind of create some extra dollars for investing. That stat really blew me away.
That's really surprising.
I ended up pulling up the source, to be honest. Like, that can't be. And like, wow, okay.
Wow. Well, any others before we hit the break real quick, Ira?
Yeah. Number 6, really, I think is very important. It's often very overlooked, especially by a lot of younger people. And that's considered the big picture when changing jobs. Because a lot of people don't realize that when you change your job, let's say you have a 401k there and you've been there for 2 years, you're going to leave 60% of the match behind. Perhaps
if you have a vesting program,
right? Yeah, if it's a traditional type of 401k,
you got to watch
a safe harbor.
You might have a safe harbor, right?
But
exactly.
you have to look at that because you could potentially be leaving money behind as opposed to staying there. Number 7 is invest. Don't keep your money in the savings account at 0.01%. And the last one was choose your real estate carefully, because a lot of people have significant wealth built up in their house. So look at the neighborhood. Is it a good neighborhood? Is it a good school district? Because you want to make sure that your real estate is in a good area so you get the full appreciation of that. I think about what's in my retirement account. I think about my house. I have a lot of money tied up in my house. So
and a lot of people, you have to think about, am I going to stay here?
Right.
Because some people don't. They move down, they downsize or something like that. And
yeah.
there are a lot of options.
I'm in the third house I was going to die
there's
in.
Evan, you're it.
But, there was a very interesting article that I had also seen, and I won't go into that article, but something that I found interesting. You can actually comment on that as an enrolled agent. It said the little things that cause the IRS to take a second look, and one of them was be careful about those side jobs because you may get a 1099. It'll be reported income to the IRS, but you're just looking at your W-2 income and reporting that.
Right.
And it could create a potential exam.
Yeah, for sure. Yeah, because people don't think about, when you're a side hustle, you might be a 1099 kind of person. It's your own business, and there's a lot to reporting as a business.
Yeah.
They can get
Well,
really
and now the
complicated.
PayPals and Venmos, they keep going back and forth on the 1099K of how much money did you get. And I know my daughter, they pass money back and forth, trading dinner checks or whatever. She may end up with a 1099K just from people paying for their share of dinner. Like, how are they going to track all that stuff?
Well, I know that I recently sold a golf cart and they Venmoed me the money. And I called my accountant and said, hey, I just sold something and are they going to send me a 1099? They said, well, if they do, we'll know how to offset it because it's a personal property thing.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.